10. Popular alternative investments. Alternative investments are assets that fall outside the traditional investment categories of stocks, bonds, and cash. They aim to provide diversification, potential for higher returns, and protection against market volatility compared to traditional investments. However, they often carry higher risks and require more research and due diligence compared to conventional investments. 1. Real estate investment trusts, R.E.I.Ts. R.E.I.Ts are companies that own, operate, or finance income-producing real estate, such as apartment buildings, shopping malls, offices, hotels, and warehouses. And they allow investors to gain exposure to the real estate market without the hassle of directly owning and managing properties. R.E.I.Ts are attractive for their potential for high dividend yields, as they are required to distribute at least 90% of their taxable income to shareholders. They also offer the ability to diversify an investment portfolio, as real estate tends to have a low correlation with stocks and bonds. However, R.E.I.Ts can be sensitive to interest rate changes and may underperform during periods of economic slowdown. 2. Private equity. Private equity involves investing in non-publicly traded companies. Private equity firms use pooled funds to make direct investments in private companies or buy out public companies to take them private. The goal is to generate high returns by actively managing and improving the underlying businesses, often through strategies like leveraged buyouts, growth capital investments, and turnaround situations. Private equity investments are typically illiquid, with long holding periods, and carry higher risk than public market investments. However, they also offer the potential for outsized returns if the underlying companies are successfully transformed and grown. 3. Hedge funds. Hedge funds are actively managed investment funds that pool money from investors and invest in a variety of assets, often with the goal of generating positive returns in any market environment. They employ sophisticated trading strategies, including short selling, leverage, and derivatives, to try to generate above-average returns. Hedge funds are known for their complex structures, high fees, and limited transparency, which can make them difficult for individual investors to understand and access. They also carry higher risk than traditional investment funds, as they often take on more leverage and engage in riskier trading strategies. 4. Commodities. Commodities are basic goods used in commerce that are interchangeable with other goods of the same type, such as precious metals, energy resources, and agricultural products. Investing in commodities can provide diversification and act as a hedge against inflation, as commodity prices tend to rise when inflation is high. Commodity investments can be made through futures contracts, exchange-traded funds, ETFs, or physical ownership of the underlying assets. However, commodity markets can be volatile and speculative, and investing in them carries significant risk. 5. Venture capital. Venture capital involves investing in startups and early-stage companies with high growth potential. Venture capitalists provide funding, strategic guidance, and connections to help these companies scale and succeed, with the goal of generating significant returns if the investments are successful. Venture capital investments are highly risky, as many startups fail, but the potential rewards can be substantial for the few that become industry leaders. Venture capital is typically only accessible to institutional and high-net-worth individual investors, as it requires substantial capital commitments and a long-term investment horizon. 6. Infrastructure investments. Infrastructure investments involve funding the construction, maintenance, and operation of physical assets like roads, bridges, airports, and telecommunications networks. These investments can provide stable, long-term cash flows and diversification benefits to an investment portfolio, as infrastructure assets tend to have low correlation with traditional asset classes. Infrastructure investments can be made through dedicated infrastructure funds, public-private partnerships, or direct investments in infrastructure projects. However, they often require significant upfront capital and can be subject to regulatory and political risks. 7. Collectibles. Collectibles are unique, rare, or valuable items that people collect for personal enjoyment or as an investment, such as art, wine, classic cars, or rare coins. Investing in collectibles can provide portfolio diversification, as their value is often uncorrelated with stocks and bonds. However, the collectibles market can be illiquid and volatile, with prices driven by subjective factors like rarity, condition, and market trends. Investing in collectibles also requires specialized knowledge and the ability to properly authenticate and store the assets. Additionally, the costs of owning and maintaining collectibles can be high, and there is always the risk of theft or damage. 8. Cryptocurrency and digital assets. Cryptocurrencies and other digital assets, like non-fungible tokens, NFTs, are emerging alternative investments that use blockchain technology. They offer the potential for high returns, as the crypto market has experienced significant growth in recent years. However, the crypto market is also highly volatile and speculative, with frequent price swings and the risk of hacking, theft, or regulatory crackdowns. Investing in cryptocurrencies and digital assets carries significant risk and requires a good understanding of the underlying technology and market dynamics. Peer-to-peer lending. Peer-to-peer, P2P lending platforms connect individual borrowers with individual investors, cutting out traditional financial intermediaries. Investors can earn higher returns than traditional fixed-income investments by lending directly to borrowers, but they also face the risk of borrower defaults. P2P lending platforms use algorithms to assess the creditworthiness of borrowers and match them with investors willing to provide the requested loans. While P2P lending can provide diversification and higher yields, it also carries the risk of loan defaults, which can negatively impact an investor's returns. 10. Farmland and timberland. Investments. Investing in farmland or timberland can provide exposure to the agricultural and forestry sectors, which can offer diversification benefits and steady inflation-protected returns. These investments often require significant capital and specialized knowledge to manage effectively, as they involve the active management of land, crops, and timber. Farmland and timberland investments can generate income from rents, crop sales, and timber harvests, as well as potential appreciation in the underlying land value. However, these investments are also subject to weather, pest, and regulatory risks that can impact their performance. Thanks for watching the video. Please subscribe.